You're welcome to this lecture, and we will be looking at ordering and accounting for inventory or stocks. Because it's an important investment in the organization. That's what the organization used to manufacture its product, or that's what they sell out to customers as well. Now, accounting procedures for ordering and issuing inventories. Because the investment in stocks or inventory constitutes a very large or huge investment, it is necessary for the organization to have accounting and control procedure, and it is usually divided along these various activities of ordering, purchasing, receiving, issuing, storing stock, and stock taking. Okay, now the procedure is this: when any department needs any inventory for use in the organization, it raises a purchase requisition note, and send it to the purchasing department. The purchasing department look at the requisition note and see if it is properly authorized. Once it is properly authorized, they will raise a purchase order, and the purchase order will be sent to a supplier with copies sent to the accounting department as well as the good receiving department. Accounting department and the good receiving department. Now, when the goods are being brought in, the goods are brought in by the supplier to the good receiving department. They look at the good thoroughly, and then they check it against the purchase order that was raised, if it meets the specification. So after that, they also check the delivery note that accompanies the good from the supplier. The essence of checking the delivery note, the purchase order, is to ensure that the good supplier actually meets specification. So once those things have been clarified, they will raise a good received note, note, GRN. This good received note evidence that they have received goods from the supplier, and it meets the specification of the purchase order. Once this good received note has been raised, then it is attached to the purchase order, to the relevant purchase order that has been forwarded to them from the purchasing department, and they send it back to the purchasing department. The purchasing department now attach it with the invoice of the supplier and sends it to the account department for payment, and the supplier is paid. So that's the typical procedure for ordering for stocks in an organization. Now, still concerning inventory, once this inventory or stocks have been ordered, we have purchased it and we have received it, the use of the inventory is also taken care of through control procedures, and they are basically into three forms. We have material requisition note. Material requisition note is issued to production department, and is just to tell the storekeeper or the man in charge of the inventory to authorize him to release the required inventory for use. and then to record same in the store ledger or the store records. So that's material requisition note. Then we have material returns note. Material returns note is used to record materials that are returned to store as unused, while material transfer notes are notes issued or raised to record transfer of inventory from one production department to another. So those are the three key notes and control procedures used in issuance of inventory. I hope you understand that. The next thing to know, after we've understood the control procedures involved in issuance of inventory, the next thing is to know is the accounting for inventory. How inventory are accounted for in the books of the company. We're going to look at a simple inventory account. Generally, inventory account, or popular name material account, is a T format account. Okay, any amount that increases the inventory, or any transaction that increases inventory is brought here. Any transaction that reduces inventory is credited. This is the debit side and this is the credit side. Okay, now in a typical material account, we always have the opening balance or balance brought down. You have it here. Then we always have the closing balance as well, closing balance or balance carried down. You have credit purchases, you see it there, or creditors. Then returns to store, materials returned to store. It also adds to the amount of inventory there. Then the amount of material used in production, we transfer it to an account known as work in progress account. Then any raw material that is returned to supplier, it reduces the value of stock. Then any amount of stock transferred to production overhead, is also credited. So that's a typical material account. Now the question might ask you to find any of these figures. It will give you the other ones and ask you to find any of those figures. So you should be able to know which one is debited on this side and which one is credited. Once you know the ones to be debited and the ones to be credited, you can easily manipulate the balance to get the one you are asked to find. So that's recording for materials, accounting for materials. Another thing again that we need to know is the valuation of inventory. Because inventory are bought at different time, at different price from different suppliers. They have different costs attached to them. Then for the purpose of accounting, it is necessary that a consistent basis is used to value this inventory. So we are going to look at the various methods of valuing inventory. Before I give the method, The essence of valuation of inventory is because the closing balance on this inventory account is used in the preparation of our income statement, so it affects the value of the income statement. If not properly valued, it distorts the profit declared by the company or by a firm. Now, the valuation of inventory, the various methods that we have are basically, we are going to look at 3. I'll talk briefly on them. We have first in, first out, which is known as FIFO. We have last in, first out, which is known as LIFO. And then we have weighted average cost method. Weighted average cost method, which is known as AVCO. So these are the 3 methods of valuation. Other methods exist, but these are the 3 we are going to talk about. The first in, first out says that it is the earliest inventory received into store that must be issued out first at that price and in that order. So what that one means, that if you receive inventory into store in 3 batches, maybe you receive 100 units at 20 naira, you receive the next one at 80 units at 30 naira, and then 150 units at 15 naira. Now if you want to, these are the amount of materials you received in store, and production needs 230 units. Production department needs 230 units. First in, first out says you must first of all take from the first that came in. It will go out first. We need 230, so we take 100 from here, 100 at 20. Then we need 130 more. We take 80 here, 80 at 30. Then that's 180. Then we need 50 more, so we take 50 here, 50 at 15. So our closing stock, that is the value of inventory remaining at the end, is 100 units at 15 naira. So our closing stock is valued at $1,500. Dollars. That's first in, first out. But last in, first out says issuance of inventory out of store must follow the reverse order. Now this is the last stock that comes in must be sent out or must be issued out. So assuming we are using last in, first out, the 3 batches of materials that we received, 100 at 20, 80 at 30 naira, and then 150 at 15 naira. If it's last in, first out, production needs 230 units. We start from the last, so the first to go out will be 150 at 15. Then we need like 80 more. Then we take 80 at 30 naira. Then our closing stock is going to be, it remains 100 units in stocks, 100 at 20 naira. That's how much? 100 at 20 naira. That's 2,000 naira. Our closing stock will be 2,000 naira. You can see the difference now. The first in, first out is 1,500. The closing stock, the last in, first out closing stock is 2,000 naira. Now the average cost method is a kind of compromise between the two. Now that one uses the weighted average valuation method. Now since the 3 batches have been received before the issue was made, we got to find the average. So it's going to be 100 at 20, that's 2000, 80 at 30, 2400, then 150 at 15, that's 1575 if I'm correct. No, 2250, sorry, 2250. So we had it up 0, 5, 6, 6650, and then the number of units is 250, 330. So the average cost is going to be 6650 divided by 330, and that is what? That is 20.15. So it is at this price that the issue will be made to production, 230 at 20.15. So the closing stock will still be valued at this average cost, and that is 100 units at 20.15. That's 2015 naira. So those are the 3 valuation methods that we have, and once a company chooses one valuation method, it must be consistent with it. As you can see, this valuation method gives different closing stocks, and that's why it is necessary to monitor the way stocks or inventories are valued. The next thing we are going to look at now is the comparison of the physical inventory and the book inventory. This is very, very important. The amount of balance of inventory in the books must be the same with physical inventory. If it is not the same, then a discrepancy or the difference must be investigated. The differences is usually due to 2 things. The first one is known as waste, and the other ones are the other factors like theft, damage, erosion. The waste is usually caused as a result of breaking the bulk quantity into the smaller quantity. The 2 of them are known as inventory loss. Inventory loss is a discrepancy that is generally known as inventory loss. So take note. Waste occurs as a result of breaking bulk into pieces, whereas the other factors include theft, damage, and erosion. Now, there are 2 things we need to look at concerning physical inventory and book inventory. Firstly, we need to look at the term perpetual inventory. It's a inventory recording technique whereby stocks is recorded and updated on every issue, out of store, receipts into store, so that after every activity the balance on stock account is always known. That's perpetual inventory, and it is recorded via the store ledger account, or it is recorded via the store ledger account or the bin card. The bin card. That's the first thing we need to look at. Then 2, we need to look at stock taking. Stock taking is the activity or is the process of determining the actual value and amount of stocks in store at a particular time. That's what is known as stock taking, counting the amount of inventory held on a certain date. And the essence is to confirm if the physical inventory is the same as the book inventory. Are we still together? Okay, so that's the essence of the stock taking. Now we have two types of stock taking, or two techniques. We have the periodic stock taking and we have the continuous stock taking. The periodic stock taking in its own case involves checking the balance of every item of inventory at the same date. Okay, maybe every 4 months, every 5 months, every 6 months, but usually it's an annual thing. It's usually at an annual exercise, maybe at the accounting year end. Stock taking, periodic stock taking takes place. You count everything together. Then the second one is continuous stock taking. Continuous stock taking in its own case involve counting and valuing stocks or inventory on a rotational basis. Under periodic stock taking, everything is counted once, but continuous stock taking in its own case is rotational. Okay, inventory A today, inventory B 2 months time, inventory C 2 months time, and by the time a year is complete, all of the stocks item would have been counted and touched. So that's the definition or explanation concerning the two methods of stock taking: periodic stock taking and continuous stock taking.